QuantSpeak, expert insights from quants for quants.
Welcome to QuantSpeak, a new podcast from the CQF Institute at Fitch Learning.
Hi, I'm Dan Tudball, editor of Wilmot Magazine, and this is QuantSpeak. Today we're chatting with Arthur Böök, who recently presented a talk on modeling the dynamics of the entire implied volatility surface with deep learning for the CQF Institute. Arthur presented with Daniel Bloch on their paper Smiling in Action, which was published in Wilmot Magazine in July this year. Arthur works as a derivatives structurer at a top-tier European bank. He says he's fascinated by the information content of markets and the potential of modern computing and machine learning. Arthur also conducts research in option pricing and artificial intelligence. Welcome, Arthur.
Hi, Dan. Thank you so much for having me.
Oh, thank you too for joining us early in the morning there. I hope you've got a good hearty breakfast planned.
That's right. Bagel and salmon, the classic.
Oh, I was expecting eggs Benedict and lots of cholesterol and stuff like that, but I guess that's probably where I go wrong with breakfast. Okay, so you had the talk, which is available on the CQF Institute now for members, and very important to note that membership is free, so there's absolutely no reason not to watch Arthur and Daniel's presentation. Before we get onto the volatility surface and deep learning, let's chat about how you got into finance in the first place, Arthur.
Yeah, so I always liked probability theory, particularly different distributions.
What was it that you liked about probability theory? Were you a gambler from age 6 or something?
I never gambled much, but I always liked how these distributions can be used for modeling phenomena. And quite early in my studies in finance, they came across as well in how they were used for estimating things in finance. So the theory of risk-neutral pricing and how that applies to derivatives pricing, particularly where the distributions can be used to derive hedging strategies that give prices for derivatives.
Yes, absolutely. And when you were studying, you did your master's in Finland, right? So in the department, what was the sort of intersection with finance that you found? What was the environment there? What was the community like around finance and statistics and so on at university?
Yeah, I was fortunate to meet Carlos Sala, who had conducted a vast amount of research in options, particularly about the risk-neutral distribution that they represent. So we teamed up and I wrote my thesis about equity risk premium estimation using S&P 500 options. Happens to be the same data set that we use for Smiling in Action. In a nutshell, we take those option prices at each day and we smoothen them a little bit to calculate the moments of the risk-neutral distribution that we then use as estimators for the risk-neutral premium. So if there's a lot of skewness, one might expect that there's a different expectation of the market participants for the weekly return of the S&P 500 as well.
Right. And once you'd finished at the university, you were absolutely dead set on a career in finance?
Yeah, that's right. I had met some people who worked at the trading floor, and they happened to work in fixed income. So they told me about swaps trading and particularly about how these exotic derivatives and interest rates are hedged. So I was intrigued by that, and I was fortunate to get an offer to work in derivative structuring, where we put together these exotic derivatives and especially the new ones that are being developed for tailored purposes for clients. So I went on to work with that, and that involved a lot of Monte Carlo simulations, as well as capital pricing. So taking into account the capital that the bank needs to hold against positions in order to be able to trade them efficiently for a return that makes sense in context of how much capital it ties up over the life of the trade.
Sure. And whenabouts was this that you sort of came into the industry?
That was 3 years ago now. So shortly after graduating my master's degree.
And at that particular time, now 3 years back, yes, certainly that's really around the point in time when machine learning really started to gain attention and traction within financial institutions. How would you say that you were already primed for that through your academic period?
I definitely think so. So that happened to be the same time as I met Daniel Bloch, who we wrote the latest paper, Smiling in Action, with. So back then we were already looking at how exotic derivatives can be priced using machine learning. So we had a project going on about using neural networks to interpolate between Monte Carlo simulated prices in order to have a quick estimator, using the neural network as a container for the prices, and then tapping into that one in order to get fast pricing for derivatives that would otherwise require a compute intensive simulation to be priced. So we had already done that before. Then yes, in the financial institutions as well, believe there's more and more data on prices, and that can be used as well. However, I'm not going to comment about my work at the banks, as it is to some extent confidential. So I'll stick to the work that is publicly available on my SSRN.
Yes, absolutely. I will ask you for all of the gossip off the record. Don't worry. So, it's just interesting to know that that's the period at which you came into industry. And the thought that I have is in terms of pushback, in terms of advocating for machine learning methods. Because I know that 4 or 5 years ago, in terms of seeing machine learning as a useful tool for a number of practitioners, there was still some question as to, now coming from a statistical background, do you feel that you were more inclined to see the advantages of a machine learning approach complementary to PDEs and all of that sort of thing?
Yeah, I think they serve slightly different purposes, in the sense that the solving a PDE is reliable and stable. So there's very little noise. You have a lot of control of what's going on. However, if you have a model with, instead of a few parameters, maybe thousands or hundreds of thousands, as they can be in large neural networks, all of a sudden your model is not so clear anymore of what each parameter represents. And that's what the beauty and the problem with these models, right? They are so large that there's little possibility to represent it in a simple way. And that, on the same time, lets us fit some functions that might be very difficult to fit with a classical PDE. So if you have something that's highly path dependent and complex, the pricing function at each point in time and space is going to be quite bumpy. And that's where these types of larger models might have enough parameters to capture the pricing function accurately. Now, at the same time, one has to be careful what we're fitting to, right? Because in finance, we have a lot of strange distributions, a lot of outliers that happen infrequently, but have a very large impact. So for instance, market jumps, such as those we saw during the COVID pandemic, they are of course important to take into account when risk managing, but they're very infrequent. So it's very hard to have a reliable data set on them. I do understand the side as well of being very careful with machine learning models, because it's very uncertain how the model interpolates or extrapolates in those events that we don't really have in the data set that we're training them on in the first place.
Yes, absolutely. Now, you were talking earlier just now about how you actually started out researching options data and machine learning applied to derivatives pricing. And there's a follow-on question from that. Why incorporate option implied information in trading strategies and risk management? Maybe we can go into that now.
Yeah, that's a great question. So I've seen a lot of trading strategies that rely on historical data. So using the past and fine-tuning the more model parameters or fitting whatever, let's say, mean reversion or portfolio optimization or risk parity on historical data. Now, that data is not forward-looking in its nature, right? Because it's only what happened in the past. And especially in the context of a large upcoming event, like if we would be trading before an election and trying to trade across, that would have an obvious flaw in the distribution, because that distribution does not represent the expectations of the event itself, but only how those expectations have been changing up until it. So I believe options data does contain a quite unique and nice property in that market participants are directly speculating or hedging the future outcome, which means that using the option data, for instance, that the mean of the distribution, so the forward price, or perhaps the variance, such as the VIX, or higher moments of the option data, this gives estimates of market participants' beliefs of the future events. So that lets you trade events and also in any moment in the market, a forward-looking way of what is going to happen. And on top of it all, because options are a liquid market, that allows us to actually hedge things as well. So if there's some part of the distribution that is uncertain or some risk that we don't want to take, the model that is fitted to options data is at the same time consistent with what you can trade in the market, allowing you to effectively modify your return distribution of your expected trading strategy based on the same options data, both in hedging and in model fitting.
What sort of challenges are sort of unique to options data, to utilizing options data, would you say?
So firstly, the noise is a big problem in the very first. If you just scrape in a bunch of option prices from, let's say, CBOE, and you look at the bid and asks, you need to first do something about those bids and asks to weed out a kind of a fair mid price for the whole chain. And because of arbitrage constraints, taking just the mid for each strike is probably going to end up with an option chain that doesn't, the mid prices aren't arbitrage achieved by themselves. So I think that the noisiness of option prices, that is some challenge that every practitioner or researcher doing options data needs to account for. So pre-smoothing and using robust techniques such as parametric volatility models that allow for an arbitrage fit in the first place, it gives a good starting point for wherever we want to go next. So for instance, in the Smiling in Action paper, we use SVI models to first fit to the market prices, such that we can then, using those parameters, have a good grasp of how the vol surface moves and also guarantee arbitrage freeness going forward.
So, having described the challenges with the data itself, what impact does that actually have on trading options?
Yeah, I think so. So trading options, there would be two sides. If you price take, you're far less in risk area of making these mistakes. So price takers would be able to just model with more freedom the distribution, and then go from there to pick out those that they want. I think for market makers, however, as you're constantly providing bid and ask quotes, these things are of critical importance, because you're showing everyone your prices, meaning that if you make a mistake, someone's going to be very quick to pick it off you. If you show an options chain that doesn't have, or let's say it contains some arbitrage opportunity, there's probably going to be some market participant that very quickly notices that and squishes you on it. So it is having a robust starting point in the first place is critical, especially for market makers in the options industry. But for price takers as well, risk managing the positions and being able to find good trade opportunities does rely on having a good representation of the vol surface in the first place. I think that's a critical first step that I've seen in research to not be, it isn't appreciated as much as I would hope, how important it is to first clean the options data and come up with a good starting point in the first place before going on to do the actual research objective itself.
Absolutely. Well, you were referring to the SVI model, one of Jim Gathrell's great contributions to volatility research. And of course, Jim, it's all about the rough volatility at the moment. Just as an aside, I was wondering what your view is on the direction with rough volatility.
Oh, I think that's a very exciting development in option prices, and also because of its complexity. I think that's a research area that should be followed closely, because the results that are coming out seem much better, but the compute intensity is at the same time a bottleneck. So it seems like we have found some methods that work better than the existing ones, but there's some interesting problems related to how we actually want to compute and in a live trading setting reach the speed of quoting as required. So I believe that's going to be a large development in the future. And I think also touching on rough volatility in the context of machine learning, there are some interesting architectures now. For instance, the transformers neural networks that are used a lot in natural language processing. These have a nice property of actually having infinite memory, which to me sounds like they could be used very well in the same context of modeling time series, the same way that rough volatility is having the property of infinite memory. These transformer networks might be useful in the context of that as well. So I'm very excited to follow on that, and I'm also, as I get some time for our next research projects, I do think applying these transformers networks to option prices is something that I'm quite keen to do.
Great. Well, I hope you'll be submitting that one to Wilmot.
I sure will.
Excellent. Okay, it's on the record now. You can't go back on that. Great. Okay, well, before we turn to the Smiling in Action paper, your co-author, Daniel Bloch, first came to the attention of Wilmot readers with work on Markov processors, and then later pricing climate derivatives with nonlinear models, as well as work exploring connections between implied volatility surface to quantitative options relative value trading. So how was it that you actually came to work with Daniel?
So Daniel and I met when I was studying at LSE. There was a research project for machine learning in finance and a mentorship program where we first got in touch. And it was the project I mentioned about exotic derivatives pricing with artificial neural networks. So that one went pretty well, and we stayed in touch. I later joined Daniel to work on a shorter project, building out a reinforcement learning library for a proprietary trader. So over that project, we became more closely in touch about future research within options pricing as we were seeing the opportunities within that field. And we decided to write a few academic papers around that as well. So we started off doing temporal difference learning, which in a nutshell takes the path of events up until the thing that you're trying to eventually predict into account. So not only looking at the weather today and forecasting what it's going to be in a week, but in the training of the model, actually looking at how today's weather converges to what it will be in a week. So every day in the future up until in 1 week's time, that data does contain some information as well, because it is the convergence itself. And temporal difference learning uses that that information to fit the model in a more parsimonious way, requiring less data points. And that actually turns out to be the same algorithms that are used in more complex reinforcement learning applications such as Q-learning or the later developments that have been going on recently. So we found that could be used for options pricing as well, because just the same way that today's weather converges to what it will be in a week's time, the market price also converges to where it will land on the settlement date in 1 week's time. So we got some pretty good results using temporal difference learning for pricing options and derivatives under then the P measure, just taking into account the actual price distribution from the past and using temporal difference learning to predict the distribution for the future and pricing with that. So we used Monte Carlo simulations for this to ensure convergence. We have not tried it on market data yet, although it is on the to-do list. But within Monte Carlo simulated price distributions, it does produce very good results.
With the paper, Smiling in Action, you noted that the model that you utilized was very sensitive to the term structure of the model parameters and required a very fine grid of volatility to converge. Can you go into that in a little bit of detail for me, please?
Yeah, of course. The main first step, as I mentioned earlier, is about denoising the data and coming up with a solid representation of the volatility surface. And this is of critical importance, I want to emphasize, for all the things that we went on to do later. So the fine grid of prices, we wanted to take the market prices, which have different strikes at different days as option chains expire and new ones come. Some chains might trade at different strikes than others, or some strikes might not be liquid for certain dates. So to have a constant representation, we need to do something about that first. We decided to go with SVI models, so fitting 5 parameters to each option chain across the strikes, to this way have a continuous representation of the volatility smile at each expiry date. The next thing, however, was that the expiries are, of course, rolling down. If an option matures in a month's time and you go a week forward, that's no longer a 1 month expiry option, but it's only 3 and some days, 3 weeks and some days left to expiry. So that roll down is something that we want to model, but we don't want to have that in the data set itself necessarily, because that means that we then would have to be fitting to different expiries at each day. So the second step is then to take each SVI model for the market traded strikes and the market traded expiries and interpolate total variance on these SVI models to come up with a constant expiry. So let's say we can see the 5-day and the 8-day expiry of 2 weeklies. Then we want to have, let's say, the 7-day expiry as a constant pillar that appears across every day, such that we have a constant representation of that expiry. Then we can interpolate total variance between the 5 and 8-day expiries that we have visible, and then fit another SVI model to the 7-day interpolated volatility, such that we now have across strikes the continuous representation that an SVI provides, and across expiries always the same pillars. So in this case, the 7-day pillar for that day. And this means that we now have, for each trading day, we have some pillars, some expiries that are always the same. And we have the SVI, which means that we can tap into any strike price and also make a dense grid of those strike prices for if we want to, let's say, quote or trade on those.
Interesting. As a sort of an adjunct to the paper, you might be pleased to know that Carol Alexander, who has just written a column for us on Bitcoin volatilities, in which she looks at the differences in terms of the way that the volatility of Bitcoin contrasts to equity index options and so on. And she notes that once more, Bitcoin volatilities behave unlike equity index options, where one only needs to build a model to forecast at the money volatility in order to predict the entire surface. Instead, one might consider applying machine learning techniques such as the LSTM model to predict the entire surface, not only the 30-day volatilities depicted, as shown in Bloch and Böök 2022. So you're already getting citations.
That's great to hear. I do remember the looking at the Bitcoin options and calculating some implied volatilities from them, and I was shocked to see how different. It's not just that the wings are bigger, but the shape of the surface also, and how it changes across expiries. I think that's a very relevant piece of research to actually look into how cryptocurrencies volatility and how options are traded, how different that probably is from traditional asset classes. So glad to hear that that citation in that paper of a very relevant field.
Brilliant. Now, what would you like people to take away from the paper, from the presentation? What do you think are sort of the three most important points, especially in terms of progressing the research that you've done?
The first point is that machine learning in general seems to be quite ripe for these problems. So fitting time series estimators to the prices, as we did, we used LSTMs, and we didn't mention it in the paper. We also tried several different architectures, among those also traditional models, such as ARIMA and such. I think there is a lot of unexplored and uncharted territory in just trying out the very recent and very modern development in machine learning into financial problems that have been around for a long time. So just the opportunity to try these techniques is more available than ever now, given that compute is relatively cheap. Fitting an LSTM is something that's even doable on many good personal computers, but with cloud compute possible for anyone to do. So I'm very excited to see how that develops and how machine learning models can be used in that context. The second point, I think, relates more to the data itself and research within options and the S&P. I think that the data sets that the options data that exist within options data are extremely interesting, because as I mentioned before, it does contain forward-looking expectations of prices, and options are very liquid now. So after 2012, there's a very big increase in the volumes traded in options, which means that they're actually not only for trading purposes very easy to use, but also in terms of sourcing that data. There's a ton of data on option prices that can be used for academic and also private research. I think those data sets are something I'm excited to see in future research being used. A third point would be that volatility has some nice properties, right? There's a clear mean reversion because it must be somewhat stationary in that it can't diverge completely. But at the same time, there's some strong trending going on, right? Volatility does tend to cluster. So if there's stress in the market, volatility tends to go up, and even more stress tends to follow. So from a modeling perspective, that's quite nice attributes to have. There's good possibilities to come up with models that are good predictors of both the trending and the mean reversion that go on in implied volatility. And particularly using larger models such as the convolutional neural networks that we used, there is some clear interrelations between the volatility of different expiries and strikes, as seen from the conclusions of the paper. that means that there's some importance in modeling these consistently within one framework, which is our main selling point. When using the convolutional neural networks to fit the full surface, we're not fitting one smile at a time and letting them be independent, but the cross relationships between different expiries and strikes are being modeled all within the same parameters, which give a dynamic model for risk managing a full volatility surface. And I think there's something to that. The conclusion that modeling the full surface with one model does give promising results and is an opportunity that perhaps hasn't previously been as much looked into.
Excellent point. Well, we'll wrap up with a final question. You know, having observed the development of machine learning and so on, what would you say is the most exciting aspect of machine learning for finance?
I think the recent developments in language modeling show that by using a very large neural network and training it in a so-called self-supervised way, we'll just let it train on data that we haven't explicitly labeled, can produce pretty good results. And I think within those transformer network architectures, the recent developments have shown that the model's ability to understand sentiment and the meaning and consequences of a piece of text, such as a piece of news, is pretty good in most measurements. And I think that carries over to finance in that market prices, according to most traditional theory, at least, tend to move when there's new information that comes out, right? Let's say there's an earthquake or something. It's natural that the options market and all other markets will have an impact from that, which in turn means that being able to efficiently capture written text and information that comes out in that form, so reading news, being accurate and fast at that should be something promising to incorporate into a trading strategy. And I think with the recent developments in language modeling, that might be very possible now using transformer networks. So scraping news and actually studying the impact of what those news say on the market could be very interesting, both in an academic research setting as well as for proprietary trading, where those events can be immediately traded and priced into the model as they come out without a human reading them and evaluating them, but solely based on a machine learning framework that reads and understands the key takeaways of the text in the context of using those for, let's say, predicting which asset class is going to move and in which direction.
Absolutely. I couldn't agree more. Well, thanks very much, Arthur. Are there any final points that you'd like to make before we bring the interview to an end?
Thanks. I think we covered everything very comprehensively. Thank you for so many good questions, and thanks for having me, Dan. It's been a pleasure.
Thank you very much. And now, listeners, don't forget Arthur Böök and Daniel Bloch's presentation, Modeling the Dynamics of the Entire Implied Volatility Surface with Deep Learning, is available now on the CQF Institute site. Membership is free, no excuses. You really should check it out, and the presentation is also downloadable. Thank you once again, Arthur. And we heard it here first. We're going to see your paper on cryptocurrencies at some point soon, I hope, at Wilmot Magazine. Thanks again.
Thank you, Dan. Let's stay in touch. See you soon.
Brilliant. Thanks very much. Take care. Bye.
Thank you for listening to QuantSpeak. Don't forget to subscribe and do sign up to the CQF Institute for more insights into quant finance.